Howdy, Jacob here. Today we're looking at Fortive Corporation in the machinery industry, 26.1 billion market cap on 28.6 billion enterprise value. They do pay a dividend, it's about 0.4%, and their revenue growth a little bit before COVID, all looking pretty good, but 3 of the 5 years pre-COVID had some pretty dampening revenue figures here. Let's see if there were some sell-offs on the cash flow statement. Actually not seen any. Okay. So I would have expected to see some positive on the acquisition side, which would have meant some devastations. But we're not seeing it. So it could just be a declined demand of their products and their services, maybe the industry as a whole. But still recently looking pretty solid, growing roughly with inflation, maybe a little bit more with acquisitions. Their gross margin is up quite a bit from 10 years ago. Operating margin actually pretty flat, maybe down a tad. Dividend wise, pay a little bit of a dividend, pretty inconsequential in relation to earnings per share. That's good. Return on invested capital, mid single digits, so not a great return on the money invested in the business. They do have some R&D spend. You're looking at about, what was that, 5 to 10% of their revenue being expensed as R&D. Again, that takes money away from today to hopefully make more in the future. Not everything's going to work, but the ones that stick should hopefully give you some fat returns. And I like to see that R&D figure up a little bit from 10 years ago. Not a whole lot, but up a little bit, which is good. Balance sheet shows just under $1 billion cash and cash equivalents with 3.3 billion long-term debt, just under 400 million short-term debt. So I am seeing a good amount of debt here. Let's look at 3 billion in relation to free cash flow. Not a whole lot. So they definitely produce a lot more cash on hand than in relation to their, or not a whole lot, but the long-term debt that they have is about 2 years, maybe a little bit more than 2 years of their free cash flow, which is a very safe figure to have. Most times debt will be due anywhere from 3 to 7 years or so. And a lot of the time people just refinance it. And so it's not a terrible concern at all to have about 2 years of your free cash flow as long-term debt. And we do see that CapEx is actually very minor. So it doesn't take a lot to keep the business running, keep the doors open. But majority of that free cash flow is going to acquisitions. Very heavy amount to acquisitions. Looks like every couple of years you're looking at a billion, a little bit more than $1 billion acquisition. And outside of that, more recently, we're seeing some share repurchases, seeing some dividends paid. That dividend paid is less than 10% of free cash flow. So we're definitely not concerned with that. Probably split between acquisitions and share repurchases for capital allocation for projection purposes. So on the revenue growth side, probably going to stick um, pretty close to inflation. A little bit more, since I'm going to assume about 50% of capital allocation is going towards acquisitions, maybe 5% or so. Pretty market average business if I've ever seen one. I hope that's not a hopefully no one's super involved in this business. I didn't mean for that to be offensive. That's can be a positive thing here. So for margins, we're seeing kind of all over the place, but definitely double digits. I love to see that. So on the net margin side, maybe around 15%, but free cash flow is consistently higher. So let's say that net margin gets closer to that free cash flow margin. So maybe do 16, 20. And for share change, they have been buying back some shares, where more recently it's just about 1%. Let's look at what about 30% of capital allocation does for them. So on 1.5 billion, you're gonna maybe 150 million, 450 million, offset by stock-based compensation, 350 million. So all I did there was, what's their free cash flow right now? What's about 30% allocated towards share repurchases equate to? That's going to be about 450 million. And then let's offset that with stock-based compensation, assuming that all of the stock-based options issued to the chief officers and whoever gets these gets offered this stock-based compensation gets issued as shares. That's going to leave about 350 million. So let's assume just 1% or so. It's pretty reasonable, fairish assumption here. And for dividend, they grew that last couple of years. Let's grow that with their revenue. And we're saying it needs to fall 63% before you get the return we look for here. So some things I do like about the business, obviously these margins in the double digits, pretty grand. You're not going to be looking at a whole lot of growth though, but obviously you can still get a massive return on company. But at this price point, I just don't see it in my eyes. Still hope you enjoy this video and have a great day.